Welcome back to Yahoo Finance Live. Oil prices sliding this morning with WTI crude oil down below $88 a barrel, Brent crude oil down below $94 a barrel as fears of demand destruction and speculation of a new Iranian nuclear deal take hold. Let's bring in Truist Securities Managing Director Neal Dingmann for more on this. Neal, great to have you on the show this morning. You've got an interesting call that oil could fall to about $80 a barrel before then jumping to $110 in early next year. Could you kind of unpack that call?
Yeah, morning, Brian. A lot of what you said, I'm quite nervous about. Just you mentioned about demand destruction. I think anything around the recessionary, inflationary pressures. Also, I just think there seems to be, let's call it artificial things that are being tossed out there into the election. So again, let's call myself a little skeptical until the midterm election. I think there's some of that built in, but more importantly, I think just to get through this inflationary, recessionary pressures, if you think about it, up until 2020, I think there was something like 23 out of 25 years, demand was at least positive to some degree. I think that's what I'm looking for. And again, I think that will actually happen starting late this year, early next year. And I think, again, when that starts to happen, you're going to see very, very quickly just how limited both on the oil and gas side supply is. And I think you have the chance for, as you mentioned, prices going up very, very quickly, up in the hundreds.
Can we dive a little bit deeper into the political aspect of that? Because it sounds like the midterm election then could be a very key turning point for where, oil prices go. Why is it that you feel like there could be the political alleviation of some of the downward pressure on oil? Does it have to do with the SPR? Does it have to do with, an assumption that someone's going to win the elections in the House and in the Senate? I guess, explain to me how that works.
Right. No, I think there is some of that. I think you've already seen with the SPR, they've talked about taking that and maybe quit taking that by, and again, it's not only the U.S. SPR, but there's a lot of others that are taken out there. Most of these are supposed to end at the end of this year. I think that's number one. Number two, we just saw the reinstatement of what they called, on some permits and leases. I think, again, that's just going the wrong way. I think, again, with some of the things the administration is doing. So I think a lot of those things you mentioned, I think once you get past this midterm election in November, I think you really will see a lot of those things start to subside. I think that the point of the fact is, again, whether it's especially domestically, whether it's oil, whether it's gas, these companies have very, very limited incremental capacity at this time. We're seeing the same thing from OPEC Plus. I think all these areas have very, very little incremental capacity, which makes to me the chance for a spike, whether that be for gas or oil, very, very possible by early next year.
As you mentioned, it's still very much a global story. So I guess I'm wondering if you had to pin it down to one big story, what do you think is kind of the bigger thing here? The story coming out of China, obviously with concerns about the growth of that country. You've got a lot of leverage issues with some of the property sector specifically, but you also have a lot of eyes on the Iran deal, right? Discussions that could ease sanctions on their oil exports if they agree to clamp down a little bit more on their atomic activity. What's kind of the bigger near-term factor here?
Yes, I think both of those are absolutely key on the demand side, but I think what's maybe equally or even more important, for OPEC Plus, you continue to see month in, month out that they're more and more compliant. Well, to me, that's another way to saying they don't have the spare capacity. They to me would be producing what their allocation would allow if they were able to do that right now. So instead of saying they're 150, 200%, compliant, I think to me, people need to look at that and tell it what it really is. It's just showing that across the board on OPEC Plus, even including Saudi, there is not the spare capacity that people perceive that there is. And again, if just demand, the two things you mentioned, I think being the most important, if demand just goes positive at all, even in a small way, I think then you're set for much, much higher prices.
Incremental difference there. Last question here. We talk about oil a lot. Nat gas doing the opposite lately, going up. What do you see as the factors there?
Yeah, I mean, you again, same thing, constraint right now on when it comes to LNG. The Europeans would take all the demand. I think right now that's the status. 70% of U.S. LNG is going to Europe. But right now, unfortunately, for those built out, U.S. LNG is about 90% at capacity already. Very, very little. We had the Freeport, plant kind of going up and down. So again, it's just a very, very tight supply demand. Anytime new capacity is added, whether it's added as LNG, whether it's added domestically, it's immediately taken up. So to me, companies like EQT, the largest gas company, companies like Antero are just going to continue printing money in the near term because there's going to be no alleviation in that constraint.
All right, Neal Dingmann, Truist Securities Managing Director, thanks so much for stopping by. Really appreciate it.